today's topic is called Do It Yourself versus Working with a Professional. But what it's really about is home of best fit. What works for you? So it's not a one-shop result for everybody. So depending on what your needs are, this is what we're going to be talking about today. Some folks are fine doing things on their own. Some folks go to a local bank and get help. Some folks go to an insurance company. It's really about home of best fit, and that's what we'll chat about today. So there's no right or wrong. Another quick housekeeping tip. So Sarah will be dropping in that evaluation form link as we start the questions. If you'd like a copy of the slides, you need to ask me in that. There's a box for you to tick, and we'll send those slides off to you. If you have questions to ask, there's room for you to ask. And there's a feature that we offer all the members of the association is a 1-hour complimentary review meeting with Andras and I. What we do is we'll just look at your portfolio. We'll maybe identify areas where you can lower your tax payments to CRA, or talk about strategies for transitioning to RIFs. So we offer that 1-hour meeting, and it's been very popular with members of the National Association. So please take us up on that if you're interested. It's not time sensitive. You know, if it takes you a few months to get yourself organized, we're happy to meet with you then. Okay, on that note, let's get started. Okay, so what is investing? I mean, for most of us, it's really just in allocating our money with the expectations of getting income or profit in interest, dividends, and capital gains. As we know, each of those are taxed at a different rate, and we will talk about that later in the presentation because it's an important part of how we invest our money. And then what is wealth management? Well, I was a bank manager for quite a few years at Royal Bank, so in there we did investments. But today when we talk about wealth management, it's more talking about what more is there than just investing in the market. There's also written financial plans. There's also tax guidance. There's also estate planning. These are things that we spend a lot of our life accumulating our wealth, and then we retire. So the question is, at what point do we work with that professional to make sure that we're doing things in the most tax effective manner?
Great, thanks everybody, and hello to you. It's lovely seeing so many people joining. For those of you who also were able to participate last week, thanks again. We really love seeing the membership making the most of the resources available to them in terms of making sound decisions. So thank you again. So with regards to investment options, to carry from Janice, there's multiple areas available to you: self-directed, do-it-yourself. You're working with an advisor at your local bank. Perhaps many of you have been doing that over the years. Trust companies, local credit unions as well. There are also independent financial advisors. You might notice firms such as Investors Group, for example, and then full-service wealth management firms. So here at RBC Dominion Securities, we are the largest full-service wealth management firm in Canada, made up of investment advisors and portfolio managers, such as Janice and I. So what is self-directed? Very self-explanatory, doing it yourself. So it's an inexpensive way to manage your investments. There are a number of companies available right now which offer platforms to trade stocks, mutual funds. There are GICs available as well. And most of the time, they are very, very low cost, transactional. So you would pay a commission every time you do a trade. But then, of course, all decisions, you would be responsible for making the decision. So whether it's research or buying more shares of some banks or adding to certain mutual funds, any kind of repositioning, that's all up to you. And most of those we find are also have these very robust online platforms as well. So primarily over the internet, but of course they all have 1-800 numbers to call in order to get some help as well. So geographic allocation, timing, whether it's timing on investments, timing related to, do you retire now? Do you retire later? All those kind of things Generally, it's very research intensive in terms of the need for individuals to go about looking at them themselves. And so what is the long-term plan with do-it-yourself? At what point do you work with a professional? Well, there too, there are benefits to working with professionals, which we'll cover as we go along this presentation, but it comes down to making important financial decisions, making informed financial decisions, being organized, and formalizing realistic goals and a way to get there. Okay, so working with an advisor at a bank, trust company, or credit union. Because of the Bank Act, there are some restrictions in the kinds of investments available depending on where your money is. So let's take a bank, for example. Through banks, you can invest in GICs, mutual funds. Usually, you can only get the bank's own GICs or mutual funds. So let's just say if you bank at Bank of Montreal, for example, and you look at buying a GIC there, usually it's going to be primarily just a Bank of Montreal GICs. Perhaps they have the highest rate on that specific date, but just to say it's the bank's own money essentially when it comes to GIC. Same thing with mutual funds. If you're dealing with a specific bank branch, again, let's just say TD Bank or Royal Bank. Because it's the retail branch, you are restricted to that bank's own mutual funds, generally speaking. So let's just take, for example, Canadian investment, so Canadian mutual funds. There's no saying that the best Canadian mutual fund is necessarily run by Royal Bank or TD or Bank of Montreal, but just to say that there's somewhat of a limit to the range of investments available to you if you're dealing at a specific bank. And I'd say that goes for trust companies and credit unions as well. Mutual funds can have a lower cost. There is an NER, which is called, an acronym for management expense ratio. That's the cost of the fund being managed for you. And particularly at a bank, there might also be a trailing commission involved in that. And I believe you might have seen a seminar or presentation on that previously as to the various compensation structures, if you will, in regards to whether it be mutual funds or dealing at various companies. So, and then lastly, I'll just say, dealing with advisors at banks or a trust company, you can usually get basic financial plans, helping you cover some of the low-hanging fruit as far as basic financial decisions. Maybe it's perhaps retirement planning, or are you going to buy a house? Are you going to sell a house? Those kinds of situations where money is in motion, you can get usually basic financial plans from a local bank or credit union. And then lastly, real quick, just through full service wealth management firms, here at RBC Dominion Securities, as we are the largest firm in Canada, the whole range of products available to you, GICs, bonds, preferred shares, which are stocks, exchange traded funds, mutual funds, and alternative investments. So let's just take, for example, us. GICs, there are 30 different issuers available through RBC Dominion Securities, and it would be the same with other investment firms. I'm not sure if it's 30, but just to say on any given day, who's to say if it's Bank of Nova Scotia or TD Bank or Royal Bank that has the highest rate. Through a full service firm, you would have access to all of those as opposed to just your own institution's specific GICs. Bonds, that's in a nutshell, that is just an organization or a province borrowing money. So if you buy a bond, you're buying an obligation from the, say, province of Ontario to pay you a certain amount of interest and give you all your money back at a set day in the future. And of course, exchange traded funds and mutual funds, very similar. They're driven by a specific mandate. So it might be this, an exchange traded fund, usually lower cost than mutual funds, that focuses on, let's say, Canadian stock. So an exchange traded fund buys the basket of those, or say infrastructure. focuses specifically on that so you can tailor a portfolio using exchange traded funds and mutual funds. And of course, alternative investments. It seems that, over the past 20 years, I've seen that definition broaden more and more and more as to what goes in there. It used to mean just hedge funds, but it can involve all forms of real estate or mortgages or leveraged products. So, that, of course, is becoming a growing element of the investable universe.
Okay, so thanks, Anjosh. So when we chat about investment management versus wealth management, because a lot of folks say, well, I do wealth management. And so I say, be aware of what the difference is. Because, for example, if you're working with someone at the, TradeX, Investors Group, a bank branch, they're working on really investment management. So they're chatting with you, as you know, when you go in to start an investment relationship, they chat with you about, all right, how are we going to allocate assets to you? Some people talk about the balanced portfolio, the 60-40 portfolio, 60% in equity or shares and 40% in fixed income. So those are things, the discussion around investment management or risk tolerance. Depending on the age of folks, we say, how much risk are you willing to take in your portfolio? If you have a pension, that is your fixed income. So maybe you want to look at, lowering your tax through your risk tolerance strategy. And then there's returns. So when investment management, we don't necessarily talk about return specifically. We'll have a client come in and say, can you get me 8%? And we'll say, well, we can get you a return. Our objective is to get you a return better than the market. So relative to the market. So yes, in 2020, 8% was achievable because markets were doing well. 2018, well, we had quite a drop at the end of 2018, so that turned into a different situation. So expected returns are something that you should always have a conversation about because you need to be comfortable with relative returns. In investment management, we talk about time horizons. And that question is really, at what point in your life are you going to need to encroach on your capital? Because really your objective in wealth management or investment management is to grow your money. So when we talk about time horizons, when will I need to encroach on my capital? Well, possibly when I'm 75 years old and I'm looking to move into more of an assisted living because I've had a medical event. So that's an encroachment on capital because we may need more money than our monthly pension provides us. Investment management also talks about portfolio construction. Which basket is going to hold which investments? And then there's also the execution of your investments and how it's done. Because you don't necessarily just put something into a fund and let it sit. Because as we've all seen in the past year, interest rates have dropped dramatically. So we have clients that might have received $60,000 a year in interest income off their GICs, and that's now $30,000 a year. So the execution is really important because it's not really passive. It should be active to what's happening in the economy. And then, of course, there's tax loss harvesting. What that means is when you have a portfolio and something has dropped in price, that's an opportunity to sell that and use that loss to offset a gain in something that might have been sitting in your portfolio for a long time. So that's a strategy that investment managers look at each year with their clients. And then, of course, the ultimate objective of investment management is growing and preserving your wealth. Okay, so what is wealth management? It's basically everything we just had on the past page, but there's a bit more to it. If there's one thing I've found in this business, Andras, and you could probably say it too, it's the emotional management of the families and clients we deal with, so that if there's an event that happens, we're there to help them. We're there to help them with the decision-making process, whether it's been something's happened to someone in the family and how can they support them, or if someone's unexpectedly lost a job or had a medical event and is unable to manage their affairs for a year. Who's going to help them? Who's going to step in? So it's really, a lot of it is, honestly, it's emotional support. When I worked in the bank, I was there to help people when they were there for their 1-hour meeting with me. But in all honesty, I was managing a branch of 9,000 clients. So I could only offer so much emotional support to people. Wealth management also means that we work with folks to help them define their goals and their dreams. And we put the word in there, fear, because people do have the fear. You know, it's a couple in a relationship. What happens if something happens to me? Will my spouse be able to step in and take all this over? Are they going to be comfortable to work on this for the next 25 years? So a lot of it is about just making people feel comfortable about their financial situation. Helping reduce the anxiety that comes with financial decisions. That's a big one where we have clients, let's say, that are 78 years old, and they're saying, at what point should we think about downsizing? We're in the big 4-bedroom house in Orleans, and we're okay with the steps, but at one point there's going to be an issue. So that's when we run a financial plan to say, okay, at what point do you leave this house, sell that house, and then use those assets to use the money to pay for rent in a senior's residence? And then they'll come back and say, well, how much money can I spend on a senior's residence? So we run that plan and let them know, can they afford $7,500 a month for that couple? Because what if one of them needs some care? So there's a lot of decisions that we help folks do through financial planning. Tax minimization strategies. That's an important one because we've spent 25, 30 years growing our wealth. We've retired, and now we say, we've got this pension and we also have a RIF and we have a TFSA. How are we best going to do things? So that's where we spend a lot of time with clients working on tax minimization strategies. Gifting and donation. Maybe when a client reaches the age of 75, we sit down and we say, okay, this is how much money you have. Are you interested in making a difference in maybe your grandchildren's lives by helping them with some money? Or is there a donation strategy that you'd like to put in place because you've got a lot of capital gains and we can save some tax because there could be some changes to tax rules coming down on capital gains? And then, of course, there's estate planning. Regardless of how old or how young we are, we should all have a will in place because at the end of the day, we don't want our family members or our whoever is going to be managing our estate and power of attorney stepping into a situation and not knowing that situation. And finally, a big part of what we do in the transition of wealth is helping the beneficiaries understand what they've received from these family members. So to help them continue to manage their wealth and do efficient tax planning. Sorry. Okay, one of the things I talked about was financial planning. We've had a lot of folks that have said, well, Janice, Andras, we're retired. We have everything planned out. And we all know that life doesn't allow us to have everything planned out that well. So one thing that we do with our clients is we do a lot of projecting. And we do all our projections to age 95. The average Canadian's living to the age of 83, 84. But those are the 83 and 84-year-olds. If I remember back to my grandparents, they ate a lot of bacon and kept that cup of fat on the side counter. And so I don't eat that way, so I'm hoping I will live longer. So when we do our financial plans, we do look at that age 95 because we want to make sure that our children are not being forced to help us through the last few years of our life because we may not have budgeted to pay for extended care or extensive health care. So this is one of the examples of how we chat about, here's our income growing, and then we retire, and there's a dip, and then there's the continuation of the growth of our assets. So just one example of how financial planning really helps folks. Okay, one of the things I talked about briefly was tax minimization strategies. So if you pulled out your portfolio today and looked at it, you should have probably 3 baskets. One is your RSP basket, which becomes your RIF basket. On the year you turn 72, you are required to start taking money from your RIF. You have your tax-free savings account basket, and then you have your non-registered investment basket. So what we always look at with our clients, and I hope you do as well, is you look at your taxable income, and then you look at your baskets and you say, where am I earning my income and how much am I paying in tax? So for example, our pension income and our RIF were taxed in the other income category. If I, for example, have held Royal Bank shares, sorry about the bias on the shares held. If I held Royal Bank shares for the past 20 years, I probably have some sizable capital gains. And if I needed that money and I cashed in those shares, I'd be taxed on that capital gain. So if I look at the chart that says my income is between 79,000 and 90,000. So my income on my pension and my RIF and my interest on my GICs, by the way, and your bonds are other income. So I'm taxed 31.48% on that other income. If I had capital gains and I wanted to take money out, maybe to give money to someone who was buying a house, the capital gain would be taxed at 15.74. And then the next column is, what if, rather than my GICs, I was investing in bonds, or equity, so stocks, or mutual funds that held equity. So I would be taxed at 8.92% on the interest on the dividends I earned from those equities. So it's interesting to look at these tax rates and say, which bucket do I have my money in, and how do I best minimize my tax? So that's when we look at those three baskets and say, what investments do we have where, and how can I minimize my tax? I recently had a client move over to us a couple of years ago, and on the second year, he came back and he asked, why did I pay $5,000 less in taxes? And I said, because you had things in the wrong bucket. So I said, it's just a matter of where my assets are and how am I being taxed. So that's something after this seminar, and if you want a copy of the slides, this table will be in there, to go back and look at your buckets and see how you're being taxed in those buckets. Because you know your RIF or your RSP is tax deferred until the day you take it out. It's taxed as other income. Your tax-free savings account will not be taxed unless you're holding US stock paying dividends. And your non-registered account is the one that causes the most challenges for folks from a tax perspective. So something to consider. Gifting and donation strategies. So here's an example of ways that we can save money easily. So you might have investments at a bank, and you might have capital gains in a mutual fund in your non-registered account. You're able to donate investments that have capital gains to organizations that accept shares, for example, or mutual funds. And you can do that directly, and that allows you to actually save money on that donation. And how do you save money? You save money because you're not paying the capital gain. So some folks in December are writing checks in December to the Heart and Stroke, to Greenpeace, Plan Canada, wherever their donations are going, Shepherds of Good Hope. And they're making those donations by writing checks. But they might be writing checks on money that they've taken out of their proceeds of money they've earned. So the objective is to try and make our donations using the capital gains that have accumulated in your non-registered investment account. So that's just something to consider rather than writing a check. So I had a client recently reach out to me who wanted to make a donation on behalf of her son to Greenpeace for his birthday. And I said, well, rather than writing the check, how about if we donate 4 shares of Enbridge or 4 shares of Royal Bank? So I said, because you have a large capital gain, and that way we'll take care of the donation, we'll send it to them, you'll get a tax receipt, but you haven't spent any money and you've just taken that capital gain off your tax event. So she was thrilled to be able to do that. Estate planning. This is a big part of what we do because it's important to have an updated, well-written power of attorney and will. If you participated in last week's webinar discussion, you definitely heard us speaking about that quite a bit. So we help folks update their powers of attorney and understand what the power of attorney was responsible for doing, because often folks don't realize what a power of attorney can and cannot do. So we help families really understand those needs, because a power of attorney could be in place for 10 years. So there needs to be record keeping, because the power of attorney is responsible to the beneficiaries in a will. And we've had cases where the beneficiaries in a will have taken the power of attorneys to court, challenging what they've done as a power of attorney. So these are important items that we discuss with family members before power of attorneys are invoked. Testamentary trusts. This is something that a lot of us may not know about, but we might have someone in our family that has needs that we say, the day I don't wake up and my assets are going to pass to my beneficiaries. Will my beneficiaries be able to manage these assets that are gifted to them? Maybe you have a relative who is unable to manage money well. They might spend recklessly. So a testamentary trust would work for that person. So in your will, that portion of money would go into the trust and then be managed so that money would go out, let's say $2,000 a month for the rest of their life or until the money ran out. Or they may be younger than 18 and even younger than 25. So in my will, for example, we have it so that if something happened to my husband and I, our children wouldn't get money all at once. It would be given over age 25, age 30, age 35, because we don't expect our children to have access to a large amount of money and not understand what to do with it. So it's important to understand that there's ways that we can help our beneficiaries after we've passed away by setting up trusts for them. Another thing we do is we help the power of attorneys in managing their family's wealth, because maybe a parent is becoming incapacitated and for the next 5 years they need help with investment management and their day-to-day activities and their tax returns. And then finally, in estate planning, in wealth management, we work with the executors and the trustees in settling estates. Okay, Andras, it's over to you.
All right, so we'll just do a quick summary here of some of the key points that we've addressed on already. So what are the benefits of working with a professional? And again, it comes down to making sound decisions and making informed decisions, because advice matters. So building your wealth. Investors who work with advisors are shown to save more money and accumulate 3 times more wealth than those who don't work with an advisor. And why is that? Well, better behaviors being one of them. Secondly, having a plan. You want to build long-term goals, putting your financial decisions in the context of reaching your own unique financial objectives, whether it's retirement, a saving and spending plan throughout retirement, receiving an inheritance or another form of windfall, perhaps through selling a house or downsizing. All of these things have implications. Next, having a strategy. Your options are there to help you make informed decisions about your financial affairs, taxes, insurance. Investments are there to work to your advantage. Keeping your goals on track. We all know that whether it be market related, I mean, look at last year, just in regards to what happened with the market. Now that's an extreme case, but nonetheless, we want to protect against poor financial decisions, want to avoid emotional investment habits. And that's really where having that bridge between perhaps your investments and the emotions can come in terms of making sound decisions. Next, making informed decisions. So this is a big one. Whether you are preparing your will, tweaking your will, appointing powers of attorney or changing them, the advice of a professional, as opposed to going and perhaps trying to figure it out on one's own, can really go a long way. Because essentially what it comes down to is helping you make important changes to your investment portfolio or your wills or powers of attorney in the pursuit of your investment, or in the pursuit of your objectives, which are all consistent with your wishes. Helping avoid mistakes. As discussed, having that wall between your emotions and your money, it's a check and balance on appropriate decision making. And lastly, it's a relationship. An advisor, a lawyer, an accountant will get to know you. They will care about positive outcomes for you. And we really can't underscore that enough. By having in place something tailored to your own specific needs, and that ongoing discussion as things change, really makes a very big difference over time, because things do change. So to end here, I'll just say professional advisor can be one of your most important resources. As you see, there's a lot of things can change, whether it's tax laws, as Janice had mentioned earlier. When it comes to even donations, there are things that can be perhaps more tax smart or tax efficient, and that's where the advice of a professional can really come in.
Now, as we said in the beginning, this seminar is really about home of best fit. So by all means, whoever you're working with, we're glad you're working with someone. And if you're doing it on your own and you're comfortable doing it on your own, kudos to you. And I think that's great. But I want to remind you that there's always a point in your point in your life, especially if you're working on your own, to think about at what point do I work with a professional? And we've often had clients come to us after retirement where folks have said, Andras, I think I need to work with a professional because if something happened to me, I don't know if my spouse would do this. And often the spouse in the room is saying, yes, please, can we work with somebody because I'm really tired of him spending 4 hours a day on the computer reading articles in the Globe and Mail. So it's interesting the dynamics when we meet with couples as to who's making the decisions and how things are done. Because really when we retire, we're supposed to be enjoying life, not stressing about the market and our long-term financial health. So who do we work with? So with RBC Wealth Management, Andras and I work with families who have investable assets of about $750,000 and above. Below that, we have folks on our team that work with smaller portfolios as well. And because it's important to us that folks understand that there's options for them. There's people there to help you. At the bank level, we were able to help, but we weren't able to give tax advice. We weren't able to help with estate planning in a robust way. So just think about the situation you're in your life and figure out, am I in the best place? And as I said with the link that Sarah's going to drop in, you have the ability to have a free 1-hour meeting with us. There's no strings attached. We can do it on a WebEx call, which is it's like a Zoom call, but it's just a bit more secure within our network. And we can just review your portfolio. We might say that you're in a great space and that everything's going to work well for you, or we might suggest some tweaks. But as part of the National Association of Retired Government Employees, you are able to have these, have a meeting with us. It's free and there's no strings attached. That's it from us.